$10,000. That's the penalty number you can trigger without committing tax fraud, without hiding money, without doing anything criminal in your mind, simply by forgetting to report a small bank account back home that briefly crossed a threshold for a day. And if you're a green card holder, a naturalized citizen, or even a US-born citizen with financial ties abroad, the IRS doesn't treat this as a minor paperwork issue. It treats it like a compliance failure in a national security-era reporting regime. Here's the part that should scare you into paying attention. Most people don't learn about FBAR and Form 8938 from their accountant. They learn about it from an IRS notice, a frozen bank relationship overseas, or a citizenship interview that suddenly turns into a forensic audit of their finances. And by the time you learn the rules the hard way, your options are narrower, more expensive, and more stressful. You're watching Immigration News Desk, and today we're doing an expose on a bureaucratic trap that sits at the intersection of taxes, immigration, and modern surveillance finance. Not a new law, not a future proposal. Rules that have existed for years, yet still blindside millions of immigrants and globally connected families, because the US is one of the only countries on Earth that expects you to report not just what you earn, but where you keep your money, even if that money is perfectly legal and already taxed elsewhere. Stay to the end, because I'm going to give you a simple compliance playbook you can follow every year, plus the devastating mistake people make when they realize they missed filings in prior years. That mistake isn't just doing nothing, it's doing the wrong kind of catch-up that can put you on the IRS's radar in the worst way. Let's start with the foundation. Most immigrants are never taught. The United States taxes based on status, not geography. If you are a US citizen, the US taxes your worldwide income. If you are a green card holder, you are generally treated as a US tax resident and taxed on worldwide income. And even if you're neither, if you're in the US on a long-term visa and you meet the substantial presence test, you can still become a US tax resident and inherit the same worldwide reporting obligations. That single principle is why people get blindsided. In most countries, tax systems are territorial, or they become territorial once you leave. People assume, if the money is in my home country, the US doesn't care. Or, if I already paid tax there, the US doesn't need to know. Or, it's just a small account for my parents. Those assumptions are exactly how you walk into penalties. And here's the first open loop. The IRS does not need to find your foreign account the old-fashioned way anymore. The compliance net is automated, global, and getting tighter. In a few minutes, I'll explain how FATCA turned foreign banks into upstream reporters, and why the classic immigrant strategy of, I'll just keep a little account open back home, is now treated like a reportable event, not a private family decision. Now, two reporting regimes are at the center of this: FBAR and Form 8938. They sound similar, they are not the same. They have different legal origins, different thresholds, different definitions, different filing systems, and different penalties. Many people need to file both. Some people need to file one but not the other. And the confusion between them is where accidental non-compliance thrives. FBAR stands for the Foreign Bank Account Report. Officially, it's FinCEN Form 114, filed electronically with the Financial Crimes Enforcement Network, not directly with your IRS Form 1040, even though the IRS enforces compliance. This requirement traces back to the Bank Secrecy Act of 1970. That name matters. Bank secrecy. The original policy logic wasn't immigrants. It was money laundering, offshore evasion, and criminal finance. But once a tool exists, it gets applied broadly. And in modern America, broad tools almost always land on normal people living normal lives. Here is the FBAR threshold, and you need to hear it precisely. If the aggregate value of all your foreign financial accounts exceeds $10,000 at any time during the calendar year, you must file an FBAR. Not at year-end, not average balance, any time. One day, one spike, one transfer, one pension deposit, one property sale sitting temporarily in an overseas account. If your combined foreign accounts crossed $10,000 even briefly, the obligation can attach, and aggregate means you add them together. This is where people rationalize themselves into a penalty. They say, I only have $4,000 in one account and $6,500 in another. That's $10,500 aggregate. That's a filing requirement. Or they say, it's not really my money, I'm just helping my parents. If you have signature authority, meaning you can control the account even if you don't own the funds, that can still trigger reporting. Signature authority is a major trap for immigrants who manage family finances abroad. What counts as a foreign financial account for FBAR purposes? Think bank accounts, brokerage accounts, certain foreign mutual funds, and other accounts held at a financial institution physically located outside the United States. Location matters. A U.S. bank's foreign branch can be treated differently than a foreign bank. The definitions can get technical fast, which is why you don't guess. You verify with a qualified professional when the facts are complex. FBAR is filed online through FinCEN's BSA e-filing system. The deadline is generally April 15th with an automatic extension to October 15th. Automatic, meaning you do not file a request. But don't confuse extended deadline with optional. This is a mandatory filing requirement. And importantly, it's separate from your tax return. You don't staple it to your 1040. You don't mail it in. It exists in a different system entirely, which is why even conscientious taxpayers miss it. They file their taxes perfectly and still fail FBAR. Now, Form 8938 is different. It was introduced under FATCA, the Foreign Account Tax Compliance Act, effective in the early 2010s, and it's filed with your tax return as an attachment to your Form 1040. FATCA's mission was explicit: break offshore secrecy and force transparency by compelling disclosure from both taxpayers and foreign financial institutions. And this is where the surveillance finance era begins. FATCA didn't just tell you, the taxpayer, to disclose. It told foreign banks, identify U.S. account holders, report their account information, or face punitive consequences like withholding on U.S. source payments. That's why so many immigrants overseas now get letters from their home country banks asking for W-9 forms or U.S. tax identification. Banks are protecting themselves. Here's the Form 8938 thresholds, and this is where people mix it up with FBAR. For individuals living in the U.S., if you're unmarried, you generally file Form 8938 if the total value of specified foreign financial assets is more than $50,000 on the last day of the year, or more than $75,000 at any time during the year. If you're married filing jointly in the U.S., those thresholds are generally $100,000 at year-end or $150,000 at any time during the year. If you live abroad, the thresholds are higher, often $200,000, $300,000 for single filers and $400,000, $600,000 for married filing jointly, depending on the rules and your circumstances. But here's the key. Form 8938 covers a broader range of assets than FBAR. In addition to foreign accounts, it can include foreign stocks and securities not held in an account, interests in foreign partnerships, certain foreign trusts, and some foreign pensions or deferred compensation arrangements depending on structure and reporting rules. Meanwhile, FBAR is more tightly tied to accounts. So yes, it's possible to be under FBAR and still owe Form 8938, or owe FBAR and not Form 8938. And in many cases, you owe both. Now let's get to the part nobody says out loud. The penalties are designed to terrify you into compliance. FBAR civil penalties can be severe. Non-willful violations have historically been treated as up to $10,000 per violation, though enforcement and interpretations evolve and can be disputed. Willful violations can be dramatically higher, often framed as the greater of $100,000 or 50% of the account balance per year, plus potential criminal exposure in extreme cases. Form 8938 has its own penalty regime, typically an initial $10,000 penalty for failure to file, with additional penalties if you ignore IRS notices, often escalating in $10,000 increments up to a cap like $50,000, depending on the situation. And if unreported foreign assets generate unreported income, now you're not just dealing with information return penalties, you're dealing with tax understatement issues. This is why I call it a trap. The rule is simple, the penalty is brutal, and the average immigrant never receives a clear warning until the government already thinks you're non-compliant. Now let's connect this to immigration, because this is Immigration News Desk, and your real fear is not just a fine. It's whether this will derail your life in the United States. If you're applying for naturalization, tax compliance is not a nice to have. It's part of good moral character analysis and the overall discretionary review of whether you are a responsible member of the community. USCIS can ask for tax transcripts. Officers can ask about whether you filed returns. Delinquent taxes, unfiled returns, or patterns that suggest willful noncompliance can create delays, denials, or referrals. Does USCIS directly police FBAR filings the way FinCEN does? Not necessarily in a simple checkbox way, but here's the risk. When you're under heightened scrutiny, any evidence of financial noncompliance can be interpreted as credibility risk. And credibility is everything in immigration. If you're a green card holder planning to naturalize, the wrong approach is to think, I'll deal with taxes later. The right approach is to audit your tax posture now, because once you file N-400, you're inviting review. You're opening the file. And if you submit an application and then scramble after the fact, you look reactive. In an era of enforcement-first bureaucracy, reactive looks suspicious. Now I promised I would explain how the IRS can detect foreign accounts. Here's the reality in 2026. The offshore secrecy era is over for most normal banking. FATCA forced foreign financial institutions in many countries to identify U.S. persons and report account information through intergovernmental agreements. The U.S. also participates in information exchange networks in its own way, and the number of jurisdictions sharing data has grown dramatically. Even if you believe my country doesn't cooperate, you can't build your safety plan on that belief. Banks change policies, governments sign agreements, and sometimes your home country bank is the one that decides you're too risky and closes your account, or reports you, because your U.S. connection is a compliance burden. Here's the second open loop. The biggest misconception is that these rules only target rich people with offshore accounts. That's the story people tell themselves to sleep at night. In reality, the $10,000 FBR threshold catches ordinary immigrants constantly, especially in countries where $10,000 is not a large life savings. One inheritance deposit can cross it. One pension distribution can cross it. One property sale can cross it. One family emergency fund can cross it. Now let me make this painfully concrete with scenarios that mirror real life. You came from India, you've been in the US for a decade, you moved from H-1B to green card, and you're finally applying for citizenship. Back home, you left an old savings account open. You rarely touch it. It floats around the equivalent of $8,000 to $12,000 depending on exchange rates and family deposits. 1 year, on one day, it crosses $10,000 combined with another small account. You now have an FBAR obligation. If you didn't file, you didn't commit fraud. But you did violate a reporting law. And if the IRS learns about that account through FATCA reporting before you self-correct, you are no longer in control of the narrative. Or you're a naturalized citizen from Mexico and you inherited a small rental property with siblings. Rent goes into a local account in your name. The income feels minor, but U.S. tax law doesn't care that it's minor. Foreign rental income is reportable. The account itself might be reportable under FBAR and Form 8938 depending on balances. And if you didn't report because you thought it's family property, you've created a compliance gap. Or you're Filipino-American and you opened an account in the Philippines to send money to family. The balance swings, $5,000 after withdrawals, $15,000 after you deposit. That swing triggers FBAR because the test is at any time. Most people assume the IRS looks at December 31. FBAR doesn't. FBAR looks at the maximum. Or you worked in the UK before immigrating, you kept a pension, you forgot about it. Years later, you apply for citizenship or you start taking distributions. Now you're dealing with foreign pension reporting complexities that can touch both income reporting and Form 8938. If any of these examples sound like you, the important message is not panic. The message is, you are not alone, and this is fixable, if you act before the IRS acts on you. Now we need to address the moment that separates people who resolve this cleanly from people who turn it into a nightmare. What you do if you already made mistakes. If you're listening right now and realizing you should have been filing FBAR or Form 8938 but didn't, do not do the most common devastating thing. Do not quietly file late forms and hope nobody notices. That quiet disclosure approach can be risky, depending on your facts, because it can look like you're trying to patch holes after the system already identified you. You want a structured approach. The IRS has programs designed to bring people into compliance, especially when the failure was non-willful, meaning you didn't know, you misunderstood, you made an honest mistake. One major option, widely discussed in international tax circles, is the streamlined filing compliance procedures. The streamlined framework generally involves filing amended tax returns for the last 3 years and filing FBARs for the last 6 years, paying tax and interest due, and certifying non-willfulness. For U.S. residents, there can be a penalty component, often described as 5% of the highest aggregate balance during the covered years. For taxpayers living outside the U.S., the penalty may be waived under certain streamlined paths. But here is the catch. Non-willful is not a magic word. You need to be truthful, you need to be consistent, and you need professional guidance if facts are complex. Because if you claim non-willful and the IRS believes the facts show willfulness, your exposure can increase. The goal is not to game the system. The goal is to correct compliance in a defensible way. There are also delinquent FBAR submission procedures and delinquent international information return procedures that may apply in narrower cases, especially when you don't owe additional tax and you can show reasonable cause. Again, details matter, facts matter. This is why I'm not going to pretend you can solve every scenario with one template. But here is what I will tell you with absolute confidence. The worst strategy is continuing to ignore it. The IRS's ability to detect foreign accounts has improved. Foreign institutions report more. Data matching is routine. And once the IRS contacts you first, your options narrow and penalties get uglier. Now let's shift from fear to control. What should you do right now to stay compliant going forward? Step 1 is an inventory. List every foreign bank account, brokerage account, pension account, and any specified foreign financial asset. Don't omit something because it feels small or family-related. Write down the institution, account number, country, and whether you own it, co-own it, or merely have signature authority. Step 2 is tracking maximum value. FBAR requires the maximum value during the year, not just year-end. That means you need statements or records that let you identify peak balances, and you need to convert to US dollars using an appropriate exchange rate methodology, often the Treasury year-end rate or another verifiable rate if Treasury doesn't publish one for that currency. The goal is consistency and documentation. Step 3 is determining thresholds. FBAR is $10,000 aggregate at any time. Form 8938 thresholds depend on filing status and residency. You might meet one threshold but not the other. Do not assume one filing replaces the other. Step 4 is income reporting. Even if your account doesn't trigger FBAR or 8938, any taxable income it generates, interest, dividends, rent, distributions, may still need to be reported on your Form 1040. The reporting of income and the reporting of accounts are related, but they are not the same obligation. Step 5 is record keeping. Keep statements. Keep proof of foreign taxes paid. Keep copies of filed FBARs and 8938s. If you're pursuing citizenship, you want your tax life to be boring. Boring means compliant. Boring means documented. Now here's the third open loop I want you to hold. The question isn't, will the IRS find out? The question is, when will a mismatch surface? Because mismatches surface at the worst times. When you apply for a mortgage, when you naturalize, when you renew a status, when you get audited for something unrelated. That's how compliance regimes work. They don't always attack directly. They catch you when you're already interacting with the system. So when should you seek professional help? If you have multiple countries, multiple accounts, foreign pensions, trusts, business interests, or any history of missed filings, you should consider a CPA, enrolled agent, or tax attorney who specifically handles international reporting. Not every tax preparer understands FBAR and FATCA. Many will confidently mislead you out of ignorance. Ask them directly. Have you filed FinCEN 114? Have you handled streamlined filings? Do you understand Form 8938 and its thresholds? If they hesitate, don't make them your pilot in a storm. Now let's end with the bigger picture, because I want you to understand why this exists. FBAR comes from the Bank Secrecy Act era, the government's fight against hidden money, laundering, and illicit finance. FATCA came from the post-2008, post-UBS scandal era when the U.S. decided offshore secrecy was a direct threat to the tax base. Some of the government's concerns are legitimate, but the collateral damage is real. Millions of honest immigrants and globally connected Americans are treated as compliance risks because they maintain normal ties to family and finances abroad. The system is rigid. That's the point. It uses blunt thresholds. It uses heavy penalties. It pushes you toward disclosure by making ignorance expensive. You may not like that philosophy, but you have to live inside it if you live inside the U.S. tax and immigration ecosystem. So here's the takeaway you should tattoo onto your decision-making. Having a foreign account is not illegal. Failing to report it can be devastating. If you learned something today, share this with one person who has a green card, one person who naturalized, and one U.S.-born person in your family who has money overseas, because this trap catches everyone, not just immigrants. And if you want more briefings like this, where we expose the quiet rules that can destroy your case when nobody warns you, subscribe to Immigration News Desk. We'll keep tracking the intersection of immigration status, enforcement posture, and the compliance obligations that can quietly define whether your future in the U.S. is stable or fragile. And remember, you don't need to be afraid of these rules. You just need to stop being surprised by them.